Howdy and welcome to the Liberty Call. Today is Monday, March 17th, 2025. Hope you're having a fantastical day out there in the interwebs. Pretty nice day here in Colorado. A little windy, so we got fire warnings and stuff. It's very dry. It always is typically at this here in this part of the country. It is arid as it can be. But so let's pray for no wildfires or anything today. And hope everyone out there had a fantastic weekend. My Cougs won the conference championship tournament, so they're a number one seed headed into the tournament this week. Very excited for that. This could be the year. It's been 41 years since the Cougs made it to the championship game. I was there in Seattle. I was a little tyke. I was 10 years old at the time, but it would really be nice. So anyways, all right. Well, markets are slipping as Treasury Secretary Scott Bessent warned of recession risks and weak retail sales growth of just 0.2% fuels concerns about consumer spending. Meanwhile, global markets are diverging with China and Europe seeing gains while U.S. stocks struggle. In major deals, BlackRock just dropped $23 billion on 43 international ports, including key locations near the Panama Canal. And in the crypto world, Trump is making waves with the announcement of a U.S. crypto strategic reserve aiming to solidify America's dominance in digital assets. So before we break all the news down, need some help from you. Give me some thumbs up, a like, share, subscribe, and follow, and press the notification bell. All right, well, let's hop into the markets. There we are. All right. Dow Jones was up 0.85%, 353 points, closed at 41,841. Let's see here. S&P 500 up 0.69%, 38 points, closed at 56,77. NASDAQ up 0.31%, 54 points, closed at 17,808. The VIX was down today, 5.93%. It's at 2048. Canada up 0.94, Brazil up 1.53, and Mexico up 1.17. All right, headed to Europe. Germany was up 0.62, the UK up 0.56, France up 0.57, Netherlands up 0.92, Spain up 1.09%, Italy up 0.95, Switzerland also up 1.09, and Portugal up 1.2%. Russian exchanges green today. MOEX up 1.62, RTSI up 3.15. And the overnight markets, the Nikkei in Japan was up 0.93%, Australia up 0.83%, New Zealand down 0.65%. In China, the Shanghai up 0.19%, Shenzhen Component down 0.19%, China A50 down 0.06%, DJ Shanghai up 0.09%, and the Hang Seng up 0.77%, Taiwan weighted up 0.03%. All right. Cool beans. All righty. Good stuff. Well, let's jump into the weekly economic update. Investors endured another volatile whipsaw week as ongoing trade talks and White House comments about the economy unsettled investors. The S&P 500 declined 2.27%. The NASDAQ dropped 2.43%. The Dow fell 3.07%, and overseas markets lost 0.95%. The markets stem losses. Stocks opened the week lower as investors reacted to the president's weekend comments about the economy. Then U.S. and Canadian leaders traded additional tariff threats, riling up anxious investors. Stocks rebounded midweek after a cooler than expected consumer price index report eased growing inflation concerns. The broad market slide resumed Thursday, but better than expected February wholesale inflation data helped buffer those losses. The S&P 500 ended Thursday in correction territory, 10% below its February 19th record close. Markets pushed higher on Friday, clawing back some losses for the week. News of progress in resolving the federal government shutdown soothed investors' nerves. All right, sunny side down. Fewer CPI constituents garner more attention from consumers right now than egg prices. Avian bird flu and subsequent culling of millions of chickens was primarily to blame for prices rising 15% in January and another 10% in February. While recent evidence suggests prices have dropped, the cost of eggs remain a sticky issue, even though prices of many other items have risen just as much, if not more. So why do consumers appear so overly uneasy? One theory is that eggs symbolize something more significant. Not only are eggs critical, inexpensive source of protein and nutrients for millions of consumers, but they're also a core part of many other foods made at home or mass produced. For that reason, eggs are a mental proxy for how consumers believe the broader economy is doing. All right. Key economic data this week. Monday, we have retail sales, business inventories, and home builder confidence index. Tuesday, home starts and permits, imports and export prices, industrial production, capacity utilization, and the FOMC meeting. Day one is tomorrow. Wednesday, the FOMC meeting, day two, and Fed announcement, Fed chair press conference. Thursday, existing home sales, weekly jobless claims, and leading indicators. And Friday, Federal Reserve official John Williams will be speaking. Just a few companies reporting earnings this week. Wednesday, General Mills. Thursday is Nike, Micron, and FedEx. All right. And that is the weekly update. Awesome stuff. All righty. Well, let's get to the market recap. SP 500 climbs as Fed meeting and Nvidia conference are eyed. The SP 500 climbed Monday as investors cautiously assess trade tariff uncertainty and economic risks following comments from U.S. Treasury Secretary Scott Bessent over the weekend that there were, quote, no guarantees the U.S. economy will avoid a recession this year. How could he guarantee or not guarantee that? He has no idea. This came just a week after President Donald Trump also declined to rule one out, adding to market jitters. Again, we could pause here, folks. We were headed into a market downturn in 2020. All that money printing basically just pushed all that out. Well, go this way. Pushed all that out into the future, and now we're having to deal with that downturn. So, is it going to be worse or better than it would have been at the time? I have no idea. But we have to go through that downward cycle. It's just part of the market cycle, part of the business cycle. You have to flush out all the malinvestment, and then things get better, and then markets then start taking off again. All right. Retail sales rebounded in February, rising 0.2% after a revised 1.2% decline in January. However, that figure missed expectations for 0.6% growth, signaling that consumer spending remains uncertain amid tariffs and government layoffs. Analysts at Jefferies noted that there was no strong evidence that consumers pulled forward demand for goods that could be impacted by tariffs, suggesting a moderate economic slowdown rather than just buying panic. Investors are closely watching the Federal Reserve meeting this week, where the central bank is expected to keep rates unchanged. However, concerns persist over whether the Fed can meet market expectations for two or three rate cuts this year. Why do we need 2 or 3 rate cuts? I mean, seriously, the economy, the rates should be set by the banking system, not the Federal Reserve. I mean, what is the price of money? And that's how you should set, is there a lot of people trying to borrow money? Well, then you raise rates. Are there not enough? You raise rates. And if there's not enough, or if there's too many people borrowing money, how to do it? No, I'm sorry. If there's too many people borrowing money, you raise rates because then you're taking on too much risk. If there's not enough, then you lower rates to incent people to borrow money. And conversely, the opposite way with bonds. If you're selling CDs or things like that, if people are buying up your CDs at 3%, there's no reason to raise rates. If purchases slow down, maybe you raise rates up to 3.5%, 4%. And usually the interest rates for those things kind of work in tandem. People are willing to give money to be loaned at the same time as people who are wanting to borrow money. Anyways, all right. I confused everyone probably. All right. Nvidia started the week on the back foot ahead of its GDC developer conference on March 18th, where the company is expected to discuss AI chip developments and competition. Meanwhile, Tesla Inc. dropped more than 6% after Mizuho cut its price target to $415 from $430, citing weakening EV sales. Robinhood Markets surged over 6% after announcing prediction markets, allowing users to bet on events like sports and Fed decisions. Because people really should be betting with their nest eggs. That's probably really smart. All righty. Let's jump into some data. February retail sales from First Trust. Mr. Nate Garzy put this together. All right. U.S. Retail sales increased 0.2% in February, rebounding from a sharp drop in January, but the details suggesting underlying consumer weakness. The gain fell short of expectations for 0.6% growth, while January's decline was revised even lower, marking the largest monthly drop since 2018, excluding the COVID years. Despite the overall increase, consumer spending was uneven, with 7 major categories showing declines versus 6 gains. The headline gain was driven entirely by a 2.4% jump in online and mail order sales, likely as consumers rushed to buy goods before new tariffs set in. Excluding this category, retail sales would have declined by 0.2%. The core retail sales measure, which strips out volatile auto, building materials, and gas sales, rose 0.5%, but only 0.1% when including revisions. If spending levels remained unchanged in March, Q1 retail sales will be flat compared to Q4 last year, marking the slowest pace since 2013 outside of COVID disruptions. Service spending took a hit, with restaurant and bar sales plunging 1.5%, the largest decline across all categories. This is concerning, as restaurant spending often reflects consumer confidence and discretionary income. The sector has declined at an 8.5% annualized rate since peaking in November, signaling potential economic trouble ahead. While retail sales are up 3.1% year over year, inflation adjusted growth is just 0.3% and remains below 2021 levels, highlighting how rising prices have eroded purchasing power. Despite 100 basis points of Fed rate cuts since last fall, inflation risks persist, and the Fed may need to remain aggressive to prevent a resurgence. Meanwhile, the Empire State Manufacturing Index fell sharply to negative 20 in March, down from a positive 5.7 in February, further raising concerns about economic momentum. All right. Well, that's awesome news. Last up here, there we go. Got an article here, the Monday Morning Outlook from Mr. Brian Westbury at First Trust. This week's article is titled, "A Recession Wouldn't Help the Budget." Well, that totally makes sense. All righty. Some claim the Trump administration might welcome a recession to drive down interest rates and ease the burden of national debt. While it sounds plausible at first glance, a deeper dive reveals the flaws in this argument. Why a recession would worsen the fiscal picture. Number one, a downturn would reduce tax revenues while increasing government spending on unemployment benefits and aid programs. Secondly, even if interest rates drop, government debt has an average maturity of 5 years, meaning any savings would take time to materialize. And the result, a bigger deficit, not a smaller one, especially with Congress likely to expand spending to, quote, stimulate the economy, much like they did during COVID. Short-term versus long-term gain. Budget discipline may bring economic discomfort, but that's different from deliberately triggering a recession. Historically, necessary reforms, whether in corporations or government, tend to be painful, but they set the stage for future stability. Political spin and economic reality. Cutting government spending while maintaining economic growth is the goal, not engineering a crisis. Net interest. Well, let me stop there, because I would argue that the whole COVID thing was an engineered crisis. But, what do I know? Net interest on debt is only 13% of total federal spending. Reducing it slightly won't offset revenue collapse. And the final takeaway, pain is inevitable when fixing a bloated system, but let's not pretend a recession is some grand master plan. If Washington had managed its finances better in the first place, we wouldn't be having this discussion. That's absolutely true. All right. Well, that's everything that I wanted to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. Be happy to help. All right. Well, I hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.